specialists, the specs, that we've got a kind of short-term value divergence in that early stage of the markets. We lost that short-term value during this squeeze here. We regained the short-term value into this low print, eventually turning the corner down here. Now, obviously, at that stage, the problem for the buyers is very simple: volume. Volume. So when we know that the problem's volume, what do we recognize that the market a lot of the times does about that volume problem? Well, we know that the market does, what the market does about that volume problem is very, very simple. They try and create volume. That's the point. They try and create volume to help out down here. So if I was to see that all the big volume was coming in on the sell trade here, and it was getting absorbed, of course, this last phase here has absolutely no volume in comparison. Look at the deltas in the background of this chart. There aren't any. That's all selling. What the hell is this? Nothing. Empty space. Nobody selling anymore. The way the bank tries to create volume is to try and show the sell. The book stays offered. We talked about this before. Now, the book was offered on the way down as well, and the reason why the book was offered on the way down was because the value was selling. They didn't want the long trade at that stage. But now that they do want the long trade, they haven't got any volume. Nobody's willing to sell to them. So they've got to try and encourage sellers in by putting offers into the limit order book to try and encourage short sellers to lean against it, to try and encourage algorithms to lean against it. Now, obviously, if they can't encourage algorithms to lean against it, what are they going to do? Well, they're going to give up, and the book changes over. So for me, it was an attack into this, and we can look at the algorithms. You can see the algorithms are all on buy programs here. See that? The algorithms are all on buy programs. They never got any sell programs in here. That's what I said earlier. And into the low price, I took 2 swings at it, managed to pick up the low print, and I've had a very, very good buy side response to this so far. You can see that's quite a nice trade off the bottom edge. And simply recognizing the process, of course, is what we're trying to do here. We're trying to recognize the reasons why. We're trying to recognize if there were any sell programs coming in to cause us problems here during this phase. We recognize that the sell programs were not selling during that phase. And we recognize why, because they simply weren't stupid enough to sell into the buyers at the bottom edge. And because of that, the volume stayed very, very low. Because the volume stayed very low, my job was to then snap up and mop up the volume that we had at the bottom edge. And then obviously the book went bullish and the market went up. It's quite an easy process if you understand the process. We covered this in the last few days' classes. We looked at the way that the order book adjusts for trade coming in, the way that the order book adjusts for volumes coming in. And we start to recognize when the volume adjusts completely off the trade. And when it adjusts completely off the trade, it's not reversed yet. We can obviously start to understand that it's about to reverse. We can start to understand it's about to reverse. Because during this phase here, there's a lot of selling, and that's right. Nobody's buying it. So you're not going to see a huge number of big orders sitting here on the bid hoping to get filled. Nobody wants filled except for exits. So when the value goes up, everybody wants filled, but nobody's willing to sell anymore. Everybody wants the trade and nobody's willing to give them it. So what happens is they start putting in sells. Sell order, sell order, sell order, sell order. They don't want filled. They just want people to sell into the lows. They'll get the fill if they take it. And obviously what they're then going to do is they're going to stop selling, going to mop up the bottom edge, they're going to start bidding into this low print down here, and they're going to take the market buy side at that stage. And from that point onwards, from the screenshot onwards, obviously, from the screenshot onwards, you can see what's happened to that trade. It's had a very, very, very strong buy side response off the low print here. Very strong buy side response. So we've managed to make $10,000 on a 30 lot trade off the bottom edge It's a reasonable profit for the amount of risk we were taking on the deal. And it's the way it should be. It's the way it works. It's the way it works. It's just the way it always works. It's the way it's always been. It's a process. It's a process that's rinsed and repeated every day in every market, everywhere. And one of the things that we've got to try and do is recognize it using the tools that we have available, things like time segmented volumes, time segmented volumes, obviously their values, the idea of how the market shakes out business. You can see it doesn't just go immediately buy side, because when this line goes bullish, of course, there's going to be some buyers come straight in here. Well, they shake those guys out. They take it south. That's what they do. That's how it works. That's how we do these trades. They try and get rid of you when the trade becomes good. And the way they get rid of you is to try and shake you off the trade. They try and shake your confidence. They try and say, are you sure? Are you really sure? What about now? Are you sure now? You say, damn it. No, I'm not sure anymore. You've pushed it too far. I don't know what the hell's happening. Exactly. You've lost your confidence. You've lost your confidence because they're shaking you out. They're pushing you about. They're causing you no end of grief.